Most Ontario retirees with $2 million in non-registered investments face the same painful reality. The more successful you've been at building wealth, the more the government wants to tax it when you need to use it. Your RRIF forces mandatory withdrawals that push you into higher brackets just when you want control over your cash flow. You've spent decades accumulating assets, and now the tax system punishes you for accessing them. But here's what I've learned working with affluent clients across Ontario. There's a better way. The wealthiest retirees aren't just withdrawing and paying tax. They're using 3 advanced strategies to generate cash flow without triggering tax events at all. These aren't loopholes. They're legitimate income structures that create tax-free or tax-deferred cash flow from substantial non-registered portfolios. Today, I'm walking you through all 3. Buy, borrow, die for wealth preservation, corporate class funds for predictable tax-deferred income, and tax gain harvesting for strategic timing. If you're managing $2 million or more outside your registered accounts, these strategies can fundamentally change how you fund your retirement. Buy, borrow, die. The wealth preservation framework. The conventional approach to retirement income is simple. Sell assets, pay capital gains tax, use the after-tax proceeds. But there's a counterintuitive alternative that preserves significantly more wealth. It's called buy, borrow, die, and it's built on 3 steps that flip the traditional model completely. Step 1. Buy. You acquire appreciating assets in non-registered accounts. Stocks, real estate, diversified investment portfolios. These assets grow tax-deferred until you sell them. No annual tax on unrealized gains. Your $2 million portfolio can compound for decades without triggering a single tax event. Step 2. Borrow. Instead of selling those appreciated assets and paying capital gains tax, you use them as collateral for a loan. This is where the strategy gets powerful. Loan proceeds aren't taxable income. You can borrow against a $2 million portfolio to fund living expenses, and you won't pay $1 of tax on that cash flow. The underlying investments keep compounding while you access liquidity. Here's how it works in practice. Let's say you need $80,000 annually for lifestyle expenses. Instead of selling $80,000 worth of appreciated stocks and triggering capital gains, you establish a line of credit secured by your portfolio. The bank lends you the $80,000. You pay interest on the loan, but that interest is often deductible if the borrowed funds are used for investment purposes. Meanwhile, your $2 million portfolio continues growing, ideally at a rate that exceeds your borrowing costs. Now, I need to address the risks honestly because this strategy requires discipline. You're taking on debt. If markets drop sharply, you could face margin calls. If your portfolio declines below the lender's required collateral threshold, you'll need to add assets or repay part of the loan. Interest rates matter too. If borrowing costs spike above your portfolio's return, the math stops working. This isn't a set-and-forget strategy. It demands active monitoring and the emotional discipline to use borrowed funds for income rather than lifestyle inflation. Step 3. Die. This is where the framework completes itself. When you pass away, Canada's deemed disposition rules trigger a capital gain on your appreciated assets. But here's the key. You've preserved the full value of your portfolio throughout retirement instead of steadily selling it down. Your estate can use life insurance proceeds to cover the capital gains tax, and your heirs inherit the remaining wealth. You've lived on borrowed funds, avoided decades of incremental taxation, and transferred significantly more to the next generation. For Ontario retirees with high-value real estate or diversified non-registered portfolios, this framework is particularly powerful. The counterintuitive truth. Borrowing against wealth preserves more than selling it ever could. Now, not all assets can be borrowed against, and not all financial institutions would allow you to do this strategy. We work with our clients to provide them access to the right assets with the right financial institution for this strategy. Corporate class funds, the tax-deferred income machine. That strategy works for those with substantial asset bases and the risk tolerance for leverage. But what if you need predictable monthly income without the borrowing risk? This is where corporate class funds become incredibly valuable. The problem with traditional systematic withdrawal plans is straightforward. Every time you redeem units from an appreciated investment, you trigger immediate capital gains tax. If you need $100,000 annually and your investments have grown significantly, you're paying tax on that growth every single year. Corporate class funds solve this using a structure I call the tax-free lunchbox. Imagine all your different investments exist inside one corporate wrapper. It provides distribution which are more tax efficient, such as dividends and capital gains. That's exactly how corporate class funds work in Canada. Here's the specific mechanism that creates tax-efficient income: T-series distributions. These funds pay out cash flow primarily as return of capital, or ROC. Return of capital isn't immediately taxable. It doesn't show up as income on your tax return in the year you receive it. Instead, it reduces your adjusted cost base, which means you're deferring the capital gains tax until you eventually sell the investment. Let's walk through the mechanics with your $2 million portfolio. You choose a T-series fund, either T5 for a 5% annual payout or T8 for an 8% payout. These distributions reset annually and get paid out monthly, giving you predictable cash flow. If you select T5 on $2 million, you're receiving $100,000 per year, paid as $8,333 monthly. The vast majority of that distribution is return of capital, so you're not paying immediate tax on it. Compare that to a traditional approach. If you withdrew $100,000 from appreciated investments using a standard systematic withdrawal plan, you'd trigger capital gains on the portion that represents growth. Depending on your cost base, that could mean $20,000 to $30,000 in taxable capital gains annually. With T-series ROC distributions, you're deferring that tax liability, keeping more cash in your pocket each year. The other major advantage is the seamless transition. Many affluent Ontario retirees hold growth-oriented funds in non-registered accounts during their accumulation years. When they retire and need income, they can switch from the growth series to the T-series within the same corporate class structure. That conversion is tax-free. You're not selling one fund and buying another. You're simply changing the series within the same corporate entity, so there's no disposition and no capital gains tax. Now, let's address sustainability because this matters. These distributions adjust annually based on fund performance. The fund managers aren't just blindly paying out a fixed percentage regardless of returns. If markets decline, the dollar amount of your distribution can decrease to prevent eroding your capital base. If markets perform well, your distribution can increase. This dynamic adjustment is designed to maintain your cash flow while protecting the longevity of your portfolio. For Ontario retirees managing large non-registered portfolios, this strategy is crucial. It allows you to generate the income you need without creating annual tax events that push you into higher brackets or trigger OAS clawbacks. Tax gain. Harvesting is counterintuitive. You're deliberately realizing capital gains during years when your taxable income is unusually low. Why would you do that? Because only 50% of capital gains are taxable in Canada. If you can trigger those gains when you're in a low bracket, you're paying minimal or even zero tax on growth that would cost you significantly more in a higher bracket year. The ideal timing windows are specific. Early retirement before CPP and OAS kick in is perfect. You might have a gap year or two where your only income is modest RRIF withdrawals or dividends. That's when you strategically sell and immediately repurchase portions of your non-registered portfolio to realize the gain. You're resetting your cost base at current market values, which reduces your future tax liability when you're eventually forced into higher brackets by mandatory RRIF withdrawals or government benefits. Another window opens after a spouse passes. If you're filing separately and your income drops temporarily, that's an opportunity to harvest gains before your tax situation normalizes. Business losses in a particular year create the same opening. Anytime your taxable income dips below the thresholds where capital gains would be taxed minimally, you should be reviewing your portfolio for harvesting opportunities. Here's the real benefit. You're not avoiding tax entirely. You're strategically choosing when to pay it. By realizing gains in low-income years, you're locking in a lower tax rate on growth that might otherwise be taxed at 25% or 30% in future high-income years. You're also resetting the cost base, so when you do need to sell those investments later, your taxable gain is smaller. For Ontario retirees, this requires coordination with provincial tax brackets and the OAS clawback threshold, which sits at $93,154 for 2025. You want to harvest gains without accidentally pushing yourself over that line and losing old-age security benefits. This isn't a set-and-forget strategy. It demands annual income forecasting and active management with your financial planner and tax specialist. So here's the framework. Buy, borrow, die for wealth preservation when you have the asset base and risk tolerance. Corporate Class T Series for predictable tax-deferred income without leverage. Tax gain. Harvesting for strategic realization when your income temporarily drops. The core insight is this. Tax-free cash flow is absolutely possible with $2 million or more in non-registered portfolios, but it requires moving beyond the standard RRIF withdrawal model. These strategies aren't mutually exclusive. You're not choosing one. You're orchestrating all three based on your specific situation, your risk tolerance, and your timing. The next step is working with a retirement income specialist who understands Ontario tax optimization to integrate these into your personalized plan. If this framework was helpful, let me know in the comments what questions you have about implementing it. Don't forget to like and subscribe this video. If you live in Ontario and are planning for your taxes in retirement, scan the QR code to see if we're a fit.